Good morning, capitalists. Here is everything you should know today. Gold and silver plunge 5 to 10% as Iran war inflation fears intensify. Trump waives Jones Act to ease oil crunch. U.S. waives summer gasoline blend rules. Fed holds rates steady amid Iran war. Rent prices plunge in the Sun Belt. Uber invests $1.25 billion in Rivian. The Dow Jones Industrial Average is down sharply at 45,752.58. A drop of 1.02% or roughly 470 points. Industrials and energy-exposed names are feeling the heat. The S&P 500 follows suit at 6,568.88, off 0.85%. Broader market breadth is weak, with sellers in control. Over on the tech-heavy NASDAQ, it's 21,933.86, sliding 0.98%. Even the growth darlings aren't escaping the pullback. Now the fear gauge is flashing a clear warning. The CBO EVIX Volatility Index has jumped 2.11% to 25.63. That's well above the 20 level, territory that often signals elevated uncertainty and potential for sharper swings ahead. Traders are hedging, and options activity is picking up. Shifting to commodities and crypto. Gold has taken a notable hit, trading at $4,585.60, down a steep 6.32%. After recent highs, this pullback could reflect shifting safe haven flows amid other macro pressures. Silver is even weaker at $70.46, plunging 9.27%. A big move that highlights risk aversion in precious metals today. And Bitcoin? It's at $69,309, down 2.58%. Crypto's correlating more with equities lately, and today's dip fits the broader risk-off theme. Gold and silver really took it on the chin, joining a broad global sell-off. Gold dropped about 4.9 to 5%, bringing spot prices down to just over $4,600 an ounce. Silver fell even harder, down 9.5% to $68.22, while futures saw losses stretching up to 12%. This came as the 3-week-old U.S.-Iran war intensified fears of energy shocks and renewed inflationary pressures. Investors were liquidating positions, even in traditional safe havens, with a strengthening dollar and widespread risk aversion in play. The mining sector felt this acutely. Gold and silver mining stocks and ETFs tumbled in pre-market and European trading. We're talking ProShares Ultra Silver ETF down 20%, iShares Silver Trust off nearly 10%, and names like First Majestic Silver dropping about 10%. It was a rough session for the sector. This risk-off mood was everywhere. Global equities, bonds, and commodities all sold off together. The European Basic Resources Index fell 6%, and U.S. futures were pointing to opening losses as markets digested the war-driven uncertainty. A big part of the concern ties back to inflation. Strikes on energy facilities in Iran and Qatar sent oil and gas prices spiking, which tilts the balance toward higher inflation risks. Central banks, including the Fed and the Bank of Japan, have been holding rates steady, pointing to those upside pressures. Speaking of oil and the direct consumer impact, gasoline prices have been soaring because of the conflict. U.S. crude pushed above $100 a barrel for the first time since 2022. To help ease the pain at the pump, the Trump administration is moving to temporarily waive federal summer blend gasoline restrictions and the limits on E15 sales. This waiver targets the Reid vapor pressure rules that normally apply to summer gasoline to control evaporation and pollution. Suspending those would allow cheaper standard blends during the supply disruptions. They're also lifting the summer ban on E15, that's the 15% ethanol blend, to boost supply and bring costs down for drivers during peak season. Sources say the EPA announcement is imminent, focused on short-term relief without any permanent regulatory changes. The goal here is clearly to provide some quick breathing room for consumers amid the war-fueled price surge. On a related note, President Trump issued a 60-day waiver of the Jones Act on March 18th. This allows foreign vessels to ship oil, natural gas, fertilizer, and coal between U.S. ports, countering disruptions from the Iran war and the closure threats around the Strait of Hormuz. Brent crude had climbed 3.83% to $107.38, and U.S. oil hit $96.32. The White House acted despite pushback from maritime unions over security concerns. The president expressed frustration with U.S. allies for not doing more to secure the strait, framing the waiver as a practical step to keep domestic resources flowing, without touching the underlying 1920 law. That said, experts caution the impact on gas prices could be limited. Refineries still face mismatches between imported crude and domestic shale oil, so don't expect dramatic relief at the pump. Shifting to monetary policy, the Federal Reserve held the federal funds rate steady at 3.5% to 3.75% on March 18th. In their updated projections, they kept the dot plot showing just one rate cut in 2026, a single 0.25% reduction, with more participants now leaning toward no cuts at all, given the uncertainty from the Middle East. They did raise their 2026 GDP growth forecast to 2.4%, kept unemployment steady at 4.4%, but lifted headline and core PCE inflation to 2.7%, directly tied to those oil supply disruptions. Fed Chair Powell highlighted rising near-term inflation expectations from the oil shocks in the Middle East, saying it's simply too soon to fully gauge the economic effects. Markets reacted negatively. Stocks fell as hopes for multiple cuts evaporated, with attention now on the persistent inflation threat from the conflict. On a brighter note for some households, rent prices are moving in the other direction. U.S. median asking rent dropped to a 4-year low in February 2026, hitting $1,667 nationally. That's after 30 straight months of declines. In the Sun Belt especially, markets are seeing meaningful relief. Austin led the way with an 18.2% drop from pandemic peaks and 7.1% year-over-year, thanks to big increases in apartment supply in those high-growth areas. 15 markets posted declines of 10% or more from peaks, including Birmingham at 17.1%, Memphis at 16.1%, and Phoenix at 15.6%. Nationally, rents were down $29 or 1.7% year-over-year, 5.1% from the 2022 summer high, though still 14.2% above pre-pandemic levels, according to Realtor.com. Every single one of the 50 metros tracked is now below its peak, reflecting that ongoing surge in supply and cooling demand in what used to be the hottest rental markets. And finally, a notable corporate move in the mobility and EV space. Uber announced a commitment of up to $1.25 billion in Rivian to scale its robo-taxi fleet by as many as 50,000 vehicles. It starts with an initial $300 million investment and options for another 40,000 down the line by 2030. The plan kicks off with 10,000 Rivian R2 autonomous units deploying in San Francisco and Miami by 2028, then scaling to 25 cities by 2031. These vehicles will use Rivian's in-house autonomous tech, including the RAP1 inference platform and multimodal perception for full self-driving capability on Uber's network. Market reaction was mixed. Rivian shares jumped more than 10% on the news, while Uber dipped slightly, with investors weighing the capital intensity of the autonomous vehicle strategy. That's the roundup for today. You now know more than most people do about what is going on in the world of finance today. Thank you for listening to The Capitalist and supporting us. Together we will make capitalism great again.